Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Christine, great to be able to catch up with you and get your thoughts on the market always. It's an interesting time, that's for sure, in terms of where we go from here at high valuations. Huge debates right now in terms of whether or not inflation is here to stay or if it's transitory. And if it is transitory, what in the world does that even mean? And all of this has an impact on our stocks, on valuations, on what sectors and exposure you want. And even for people who are just kind of really getting to learn about the investment industry, they need to know that the rate that they pay on their credit card, their auto, their mortgage rates, whatever, everything is going to be affected by really the interest rate environment. And that's why it's talked about so much. I don't remember us ever talking about it this much. So, but this is front and center. So why don't we get your perspective in terms of where you stand running the company, running your investment firm?
Sure. Well, definitely, Catherine, you're right, because inflation for the last 20 years has been like around 2%. And it's been actually, the central banks have been trying to get inflation up. And now, since the spring, it has spiked up to, over 5% in the core. The latest reading, the core CPI in Canada was 4%. So we've had a spike up. I am in the camp that it's transitory or not permanent. I think that it may stay with us longer than maybe what the Fed initially expected when when inflation started to spike up in February, because of all these bottlenecks and shortages that we're reading about. And it's all, I think, going to come down to when we can get the COVID-19, the virus, everyone getting vaccinated, because we also forget that the global economy is so interconnected. Yes, in Canada, our vaccination rate is very high, over 70% fully vaccinated. But you have other parts in the world where it's still single digit, and a lot of goods that are made and shipped come from those countries. And so that's causing a lot of bottlenecks, because if it breaks out, they have to shut down. So it's going to take some time. I know the World Health Organization, they're targeting to get the global population vaccinated 70% by next September. Now, is it going to take that long for everything to get sorted out? Hopefully not. But I think for stock markets, it's not, it's kind of old news now. We're hearing it, like you say, inflation, higher interest rates. So the market is expecting, when companies report this coming quarter, they're going to be talking about inflation and high elevated transportation costs, but it's going to be more the commentary of looking forward. Are things getting better? The rate of change. And I think that will be supportive for markets if it is slowly improving.
So the rate of change and slowly improving, that sounds like that's your stance, that you believe that is what is occurring. But there's also big debate around whether or not that is occurring, in the sense that, we saw weaker than expected economic data out of China. You are seeing some of and you have to think about some of the small cap companies in the United States that won't be able to handle and manage these higher costs and the bottlenecks. It just won't work for their businesses.
Yeah.
So, and then we've got the U.S. Federal Reserve and their GDP expectations and their inflation expectations. I mean, what are we in right now in terms of the growth outlook? Because that's also key as well, in terms of whether or not we can grow into these valuations.
You're correct. And like, we do know GDP estimates in the last few months have been revised down. I mean, they're still growing above trend, but I think it's more of an issue that the recovery, it's still ongoing, but the pace of the recovery has been delayed because of Delta variant and these issues, but it's going to still improve. And so I think we've seen GDP estimates being revised down for this year, but in some cases, economists have revised it slightly upwards for next year, saying that, this is going to be pushed out. I mean, the one plus you can take away from this, Catherine, is the demand seems to be there, right? When the economy is reopened in the US and we're seeing in Canada, people want to buy. There's a demand for goods, which is causing this kind of imbalance between demand and supply. I think what would be even more discouraging if there was no demand for anything, and then the economy kind of just stops. But the demand seems to be there. Prices are going up temporarily, and you made a good point about larger companies maybe benefiting, because we know that larger companies such as Costco and Home Depot, they're contract their own ships and getting into other ports to get goods in. So the profit outlook is very important, because I think that's what's driven the markets up this year. If you look at the valuation multiples, where there's even on 2021 earnings for the broad indices, we're the same multiple that we were at the beginning of the year, but the market's up almost 20%. So to me, it's been positive earnings revisions that have driven this market up. Going forward, I think it's going to remain important. We'll have to see what companies are saying this upcoming earnings season. But we are also seeing companies invest in technology. Technology spending and capital spending was up very strong last year. And I think companies are using technology to try to offset some of these cost pressures. And so that's going to be a fine balance. But I do agree that, continued profit growth is important. And so far, it hasn't been so bad. They're very early on in the earnings season. We've had the banks report, as you know, and they still see that we're on an upward path to recovery, but it may be delayed because of these issues.
Mm-hmm. Let me, since we briefly are mentioning earnings, what is your overall take on the earnings season so far, and also the banks and just some of the huge beats in particular of Goldman Sachs as an example, and whether or not you see that continuing?
Well, Goldman Sachs and the capital market activity has been very strong. That's helped all the banks. I think for the more kind of consumer and commercial oriented banks, the key metric has been loan growth, because that's been an issue that everyone's saving. The banks have so much deposits in their bank accounts, but they're trying to utilize that cash in terms of loan growth. Yes, mortgages are growing, and we're starting to see a slow pickup, which is good. Companies have a lot of cash on their balance sheet. Last year, a lot of companies raised money just because so they could have it in case, for emergency, because they didn't know what the outlook was going to be. And also, as we know, the revisions they've been releasing those as the economy's been improving. All the banks, U.S., Canadian, put up a lot of provisions last year. The U.S. banks are probably ahead of the Canadian banks in terms of releasing those provisions. You don't get full credit by the market when they see those provisions come, released. But it's still a positive. It's going to help their bottom line, and they're still going to grow their book value, which means that price to book value is an important metric for banks. So that becomes more attractive. So I like the banks, generally speaking. I think they've shown that they're diversified in terms of their business mix, capital markets, wealth management, and they have a lot of capital on their balance sheet. And as you know, Catherine, in Canada, these banks have been building that because they haven't been able to increase their dividends or do share buybacks. And so there's still that catalyst to come.
So when you talk about the banks, though, do you like both Canadian and U.S. banks, or are you favoring one more so than the other?
I like the banking group as a whole, and we do have investments on both sides. But I think right now, the Canadian banks, even though they have done well, they have lagged the U.S. banks, and arguably, and if you take a step back, once again, the releasing those revisions has lagged, so maybe that's one of the reasons. But as well, you look at the jobs number that was released last week. The Canadian economy has actually bounced back quite nicely in terms of employment, because we're back to pre-pandemic levels, where the U.S. is still underwater by 5-6 million jobs. So it could be because our vaccination rates are so much higher than the U.S. in terms of fully vaccinated, that maybe in the long run that's going to be beneficial for our economy. So and I think the banking sector reflects the health of the economy. So as we get those positive economic data, that means that kind of feeds into their provisioning and how much they can release. So that's going to be beneficial for the Canadian banks. So because of the relative underperformance between Canadian and U.S. banks, right now I would favor the Canadian banks over the U.S. banks.
Just from a relative underperformance perspective, and maybe a bit of a catch-up trade?
Yeah.
Okay.
Correct. And the valuations, I think the valuation gap is a bit wider still between the two. And, for ourselves, we consider the Canadian banks as income stocks. And so we think their yields especially non-registered accounts, much more attractive if you get the dividend tax credit. So, so it's much more beneficial tax-wise actually to own a Canadian bank and collect that dividend with the dividend tax credit.
What's the top Canadian bank for you then, since we're on it?
Since we're on it, well, Royal and TD are our top favorites, and I would think probably more so if I had to choose between the two, TD because it has lagged somewhat in terms of over Royal and over the overall group. And I think TD, they do have very good exposure to the U.S. economy as well, so you get a more geographical mix there. And they have a lot of capital. They're the most, I guess, capitalized bank of all the Canadian banks. And they also have that interest in Schwab, which they can redeploy if they want to make an acquisition to grow. I think they're going to be very disciplined in what they buy, but also that's another alternative source of capital if they come across something.
Okay. And just again, from a top-down perspective, we talked about the economic growth outlook. Let's just dig into China a little bit, because a couple of weeks ago there, really was a bit of a scare, maybe not too much of a scare with respect to the Evergrande property developers and whether or not there's more of that to come and what that might mean for global growth. And in particular, some of the cyclical areas of the market, if China is in fact slowing or they have a bigger problem and can't ring fence it, what might that mean for, some of the metals and miners, copper, et cetera? I mean, nobody seems to care about that today, but what do you think?
No. Well, obviously China with their common prosperity platform, it's impacting a lot of sectors. We saw that in technology, in their tutoring sector, where they decided you can't make any money there and no longer, and that wiped up a whole sector. And with Evergrande, you're right that if property development slows, which may materialize out of all of this, then demand for those commodities, such as steel, things that are used to build bridges and buildings, that may dampen demand. And so that will have an impact. Personally, we're not in that sector. The base metal mining sector is very cyclical. And I think a lot of the growth in the past has been driven by China. But now if they're going to slow, but you have to remember, Catherine, like it is like a autocratic society, right? So, they've said that they're not going to rescue Evergrande, but the government has been injecting liquidity into the system, and they want to make housing more affordable for the general population. And so, and property, real estate is such a large component of China's GDP. It's almost 30% based on some of the reports I've read, that it's really an important sector for China. So I don't think the government will let the sector, collapse. Like they'll do little things where local state governments have to step in, they put more liquidity in the system. And I think they'll manage it internally, and they're going to decide what the economy is going to grow at. We saw that 4.9% number being printed. And then you had the government official say, we're not concerned. We think we're still going to meet that 6%, GDP growth target. So it's hard to say what the actual real number is. But China's a large population, and it's been a growth sector for a lot of different industries. But I do agree that the mining sector, the base metal demand may get dampened because of what's going on over there.
Okay. And we could dovetail that into China's impact on the energy sector, but the energy sector has such different dynamics right now in terms of the lack of supply because of really the vilification of the industry for so many years, underinvestment, and here we are. And then so interestingly as well, more commentary in the media amongst investors saying that, if the wind isn't working right in Europe, you got a problem. Yeah. And we're really seeing that. And now we're entering, or could be entering, into a very cold winter. That's the view these days. But regardless of the seasonality, there's a real lack of supply, and therefore, regardless almost of what happens in China in terms of their growth path, we could be in a bit of a predicament where, the demand, the supply is crossing right now, and we are seeing much higher priced oil, $80 with an 8 handle on it.
Yeah. Well, I actually don't think it's a supply issue if OPEC decides to produce more, because they've been very disciplined in raising production. I mean, I think they can if they wanted to. For some reason, they've decided to kind of really slowly put production back on stream. And in terms of what's happening over the UK, that's really kind of a unique situation. They transition, you're right, that to renewables at a faster pace than they maybe should have. And there's this reliance on Russian imported gas. And Russian, for various political reasons, can kind of dictate how much they want to export. So I think it's a temporary dynamic that you might see elevated prices for a while. But I think I've also read that the UK has decided that they don't want to be held hostage to imported natural gas. So it's actually going to quicken their transition to renewables even more. So maybe it just has to be better technology developed for storage, for these renewables. I don't think we're going to go take a step back. Like personally, you're right. The energy patch companies, they're thinking longer term, and they're not spending quite as much money to develop new fields because the long-term trend is probably going down. And so, to me, I think the rate of change in terms of price appreciation in crude oil is probably behind us. We're not going to. I'm not a believer that we're going to get to 100. A 3 handle on crude. There can be production that's brought on stream, but it just hasn't been done yet. So I'm a big proponent that longer term it is still going to renewables. We're not taking a step back to carbon fuel.
Interesting. And with respect to your investment style, and recognizing that energy is cyclical. Do you guys even invest in it? Like, do you buy a big bellwether like an Exxon or no?
We have not invested in an energy producer, I would say, since last 4 or 5 years. We have decided to have our energy exposure through the pipeline stocks because of their dividend yield. Their yields are around 6%. So you have that defensive yield support if the commodity goes the wrong way. And in fact, sometimes the yield goes up. And I think pipelines, they're largely insulated, at least for the next near or medium term, to changes in the commodity price, but they get kind of slots in that bucket because they're part of the energy complex. So we've stayed out of the producers. So yeah, we missed the upswings and the downswings. And, energy is in our kind of what we consider a growth equity. It's definitely not an income equity other than the pipeline. Mm-hmm. And to me, it's very cyclical growth, as you mentioned. And our preference is always to buy in the growth bucket, a company in a secular growth industry. So we've shied away from that sector, except for the pipeline stock.
Got it. And investors have to realize, it's great when you see, energy rise the way it's been moving. But, as we know, it can decline and stay down for a very long time as well. I mean, you really have to kind of, I think, be an expert in the area to invest in it to a large degree, and make that.
And you have to trade it.
Yeah, you do. I remember when I was covering one of the largest hedge funds in the world, the guy who ran the energy book said to me, he goes, Catherine, it's simple. He said, if the price of WTI is going up, the stocks are going up. If it's going down, they're going down. I mean, that's a simplification, but it's not too far off the marks. So I've never forgotten it, and also, employ that in my own investing. But so we've covered kind of the macro, the growth picture. It's interesting then, Christine, if in fact the variants have and the vaccination rates have delayed almost the getting back to pre-pandemic levels. To me, I really am kind of thinking of the world as an elongated reopening trade. So that we're not going to be going back into recession. We won't go into recession. We maybe have a nice long runway for a business cycle, but then there are those who will say, no, we're going to go back into recession. There's too much debt, et cetera, et cetera. Where do you stand?
I think I'm in more of your camp, that it's a prolonged recovery cycle. We're still very early in the recovery, I think. And in terms of the debt issue, I think that will actually keep growth at somewhat moderate pace, which actually is not that bad, like kind of slower growth, but a longer period of growth. And hopefully once these bottlenecks get resolved and things kind of go back to where they were, pre-pandemic. And, and we talk about interest rates, everyone's talking about interest rates, higher interest rates, but, you take a step back, they're at very historically low levels. Like even the 10-year US Treasury bond, it spiked up to 1.73% in March earlier this year when inflation started to kind of rear its ugly head. And now today it's 1.6, 1.60. So it's still below where it was in March. And so, that's a very low interest rate all around the world. So yes, the Fed, also central banks will eventually start to increase interest rates. They're tapering. The Fed hasn't even started yet. But at this point, interest rate increases are probably not going to happen at least until next year. And I think it'll be very gradual. I think that the governments realized, this self-induced recession was not, it was self-induced because of a health crisis. And they've put so much money into the system to make sure everyone comes out of it whole, that they're going to be careful to make sure it stays on track. We know the Canadian benefits, a lot of those subsidy programs expire, I think it's next week. And I think, maybe I don't know if they need to extend it fully. I think maybe it should be targeted to certain industries that are still hurting, like the tourism and hospitality. But I think it's going to be longer. And it's not, I was listening to J&J's, just heard their investor, they had the report this morning, and they talked about the medical device area, which, they benefit, elective surgeries, as you know, during COVID were delayed, in some cases canceled. There's a huge backlog. And they were seeing improvement through the beginning of this part of the year. And then it kind of plateaued because of the Delta variant, and hospitals got, filled up with COVID patients again. But then now they're seeing it stabilize and starting to improve again. And the commentary was that it is a recovery. They don't anticipate a step back to declining elective surgeries. So I think that's you can kind of use that analogy for the whole economy. We're slowly getting better. And as we talked about emerging markets, as their vaccination rates go up from some cases like in the teens to 60 or 70%, it's only going to get better in terms of opening up business and for consumers to spend. So I think you just take steps to a better environment from here.
Having spoken about J&J and their results, let's talk about some of the stocks that you like for your clients right now. And Disney, they just reported as well, and then it got a downgrade from an concerned about their streaming. So what's the latest with Disney?
I don't think they haven't reported yet, but I think there was a commentary that the CEO made at an investor conference about a month ago that, they have these streaming targets, like it's 230 to 260 million subs by fiscal 2024. And he kind of made they're about 116 right now based on their last quarter. He made a comment that it's not going to be a smooth path to that. Like you're going to have, some quarters you do better. And people kind of thought, oh, maybe he's pre-announcing that they're not going to meet whatever consensus number is out there. But you're right, they got the downgrade yesterday from an analyst that maybe their streaming additions, the subsidiary additions, may be slower than anticipated. To me, that's, I don't really care whether it's quarter to quarter, like it's growing. And what other company can start a streaming service in the middle of a pandemic and garner 100 million subs within a year, because they have content. So to me, the streaming side, they kind of address the whole linear, watching stuff on TV and going to the theaters. They're going to manage which is the best way for them to distribute their films. And for a reopening play, it's really about their parks and resorts and their cruise ships, because they were shut down last year. I mean, they lost like $3.5 billion because the parks weren't open. Now they're getting fully opened up. And they're also constantly doing yield management in terms of getting better productivity, so that once you go into that park, you're more efficient in your time and you have more time to spend is what they want. So yeah, I think Disney is a great long-term growth story. And these little pullbacks that you get are great opportunities, I think, to initiate positions.
Okay. Let's talk a little bit about Zoetis as well.
Yeah. So it's animal healthcare.
Yeah.
Yes. Animal healthcare industry. And this is a name that we've only added in the last, 6 months or so. I always liked that industry. And the reason being, in animal healthcare, I mean, Zoetis is in pet as well as livestock. It's like the leading player. It's almost like an oligopoly. That industry's been consolidating. And it's a little different from human healthcare because the patent life to their drugs is much longer, usually like 25, 30 years plus. And usually when the drugs go generic or off patent, you end up maintaining a lot of that volume. Prices go down a bit because there isn't really a strong generic competition, generic industry within animal healthcare, whereas there is in human healthcare. And so even though, so your product shelf life is much longer. And in terms of livestock kind of grows along with GDP, but we really like the pet companion side. The pet expenditures has been growing kind of at 5, 6, 7% annually for the last, 5, 7 years. And we see that continuing. We know during COVID, and this was not necessarily the reason why we bought it, but we saw a lot of people buy or adopt pets. And they've noted that, the overhang was, does this, when people go back to work, are they going to give up their pets? That trend does not seem to be playing out. And in fact, it seems like more people want to add another pet to the household. But they've also found that demographically, younger people are having pets in their household, and they tend to spend more and go to the vet more. And pets are living longer because they're being treated now. And as well, like Zoetis also has some very good drugs out there. They're usually the number 1 or 2 position in that whatever health category, whether it's ticks, fleas, or arthritic, and they're doing diagnostic tests. So we just think the pet industry is the animal health care, which PET's part of. It's attractive. It's going to grow above GDP, and Zoetis, as one of the leaders, is going to benefit.
Yeah, I actually just added another pet to our family 2 weeks ago. It's killing me anyway. She's cute. She's a bit of a pistol. But so Christine, with Zoetis right now, because I can't believe I can't remember this. I was just trying to look it up. What were they spun out of? It wasn't Pfizer, was it?
Pfizer.
It was
Pfizer, like back in almost 10 years ago, they spun out of Pfizer. A lot of the large pharmaceutical companies had a pet healthcare division, and over the years they have spun that out to become more focused, like they just on adult healthcare.
Interesting. And is the valuation attractive at these levels?
It trades at a relatively higher multiple because of its, I think, dominance in the industry and the more attractive attributes of the industry. But, I think it's kind of like growth at a reasonable price is how I view it. It's not a value stock necessarily, but I think that, I like the secular growth trends of that overall industry. And I think, they're the leading player there. So.
Okay. We've just got a few more minutes, but I do want to get a couple more from you because it's interesting. Some of these names. Invista Holdings. I'm not familiar with it. I don't think I am. Wait, what is that?
Yeah, so this is a dental products company. So they supply consumables and equipment to the dental industry. And this company was also spun out of Danaher, which I'm sure you know what Danaher is, the industrial conglomerate, which is now really considered a healthcare company. They were spun out in September of 2019. And then Danaher exited their full position in December of 2019. So the company's been public for about 2 years. And once again, the dental industry, we think is attractive. It's growing kind of mid-single digits. In developed markets, people are living longer and people want to keep their teeth longer. Unlike, maybe our grandparents or great-grandparents, whereas you got older, you just got your teeth pulled and you had dentures. Now the objective is to keep your teeth. I've had a few implants put in, right, and as well as cosmetic applications where it's aligners. So that's a nice, I think, demographics work in their favor. And then emerging markets, developing markets, dental care is the penetration rate is very, very low. So that's like a long-term growth opportunity for the company. It's quite global. It's been around for a number of years within Danaher. And about half the revenues come outside of North America. And so since the spin, they have been investing more in their R&D. And when I talked about the aligners, they were kind of late to launch their own aligner platform. They did launch one last year called Sparks Aligner. So I think they're getting good growth from that. And they're the leading player in the orthodontic implant area in terms of but they haven't refreshed that product line in a number of years. And they've just recently done that. They're going to be launching that this year in the US. So I think with their installed base, it's going to be a good cross-sell onto their new platform. So those are a few catalysts. And it doesn't pay a dividend. They're reinvesting in their business. And I think the multiple, it's about 18, 19 times forward earnings. So it's a reasonable multiple and an attractive industry. And once again, it's kind of an oligopoly. Like there's, kind of few major players, and they're one of them.
Okay. And when you say liner, you mean like an Invisalign teeth straightening type of thing?
Exactly. Yeah. Invisalign is like, it's their product in terms of the clear aligners. Invisalign's a competitor in that space.
Okay.
And Invisalign trades at a much huger multiple because aligners are experiencing very good growth, right? So now Investa now has their own aligner platform out there.
Okay. Otis Worldwide, so elevators.
Elevator and escalators. And, this company was part of United Technologies, and they got spun off, I guess I think during around March or April of last year. And we actually used to own United Technologies, and we kept Otis and built that position up. And we like that sector because it's, once again, oligopoly. Otis is the leading player, very global. And the reason we like it is the service element. The aftermarket, it's about 50% of the revenues, and the other half is original equipment. But the aftermarket accounts for 80% of their profits because it's very high margin. You think when a developer buys with Otis elevators, you buy the equipment, but then there's this kind of 10-year service contract that comes with it. And, elevators and escalators are kind of like the engine of the building. It's kind of mandated how often you have to have service. And for Otis as well, they have a large presence in the UK and Europe and the EU, and elevators there are quite old. They tend to have to be modernized after 20 years. So it's aging, it's past that time period. And then finally, we talked earlier about China and the real estate fiasco that's going on right now. Otis has been pulled back. It's pulled back in all the elevator stocks. Schindler and Kone are their competitors because of concerns that if property development really stalls out, China's kind of been a growth area, then the growth will slow there. I think for Otis, it's about 15 to 16% of their revenues, but they own it through joint ventures. So it's only about 7% of their actual earnings. So I think it's very manageable. And I think the pullback is a bit overdone. So it's actually a very attractive entry point, I think, to buy that stock now.
Interesting. And then lastly, Linde. Linde,
yeah.
Linde.
So it's an industrial gas company. They bought, originally based out of Germany, and then they bought Praxair in 2018, which is a U.S. company. And the industrial gas industry's always intrigued me because so they bought Praxair. So now they're the largest global player. It trades in New York. Their head office is actually in the UK. But the industrial gases are used in so many applications. It's really critical in a lot of processes. And so they would say that about 40% of their revenues are to end markets that are very resilient. Healthcare is about 30%. So they supply oxygen to the hospitals, like chemicals for MRI machines. And so they kind of benefited through COVID because of that. But elective surgeries are also going to pick up. So I don't think, it might soften the growth, but it's going to continue. Healthcare is actually a growth end market. And then electronics is another end market. And they're benefiting from this, all these semiconductor plants are being built around the world because they supply a lot of pure gases that are required in that process. There's just being growth there. And as well, they will participate with the general pickup in industrial activity. And many of their plants, because it's so critical to the manufacturing process, they're actually located on site and they're under like 10, 20-year contracts. So there's a long-term nature to some of their contracts. Yes, there is a portion that's more merchant-based, meaning, it's only 1 or 2 years. But this company is, they have synergy targets when they bought Praxair, they're achieving. And it's a really interesting company because even last year during the recession, they grew their earnings 12%. That's maybe partly because of the healthcare side with the oxygen demand. But they always, they targeted this year that they could still grow double digits, even if there was no GDP growth. We know that GDP growth generally has been much stronger than it was expected to be in a year. So their earnings they've been revising their earnings guidance up. And so I think this is the industrial gas industry, oligopoly. They have long-term relationships. typically once you're on site with the customer, unless you really mess up, they're pretty well with you for a long period of time. So reopening in terms of just general pickup in industrial activity, but also involved in very attractive end markets. And finally, they're also in longer term, it kind of plays into the whole renewable green energy space because they're supplying hydrogen to help build out hydrogen infrastructure in countries in Asia where they're a little ahead of, like in South Korea, where they're a little ahead of other geographies. So they're playing into that space as well.
Interesting. I haven't looked at that name. That's why I pronounced it incorrectly in a long time. So it's an ADR that trades on New York in addition to Europe? No?
It's just a stock, yeah.
Oh, what's the ticker?
LIN. LIN.
Okay, LIN. Okay.
Yeah.
And just
it's well known in terms of, because half of it is Praxair, because Praxair was a U.S. based company, right?
Right.
So, which is probably why they listed there, because for their shareholder base, that would have come along with when they bought Praxair.
Yeah. You want to keep those shareholders not exiting your stock for sure. And just speaking of healthcare, Abbott Labs, what's the interest there these days? What's that valuation looking like?
It's not just that. I mean, we've owned Abbott Labs for a number of years, and our client portfolio is in the healthcare space, and we like healthcare. And so it's a diversified healthcare company, established pharmaceuticals is kind of their branded generic business, and they sell most of these products to emerging markets. Emerging markets, about 40% of their revenues. And then they have medical devices, and then diagnostics and nutritionals. So, but just nutritionals, you would know Ensure for adults and Similac for infants, so those products. But this past, they've always been, I think, a very well-run company, posting double-digit earnings growth, increasing their dividend every year. They have a yield of about 1.5%. Through COVID, this company benefited because they did the testing for COVID testing, the lab-based one, as well as the rapid response. And so that really brought a lot of their earnings forward, because that became a whole growth area for them. And then in June, when they actually brought back their numbers for the rapid testing, because if you recall, Catherine, when the U.S. started getting vaccinated and reopening, the health officials kind of said, well, if you're vaccinated, fully vaccinated, you don't have to get tested, et cetera. But we know that's kind of changed in the last couple of months with the Delta variant. Now everybody, if you're not vaccinated, you have to get vaccinated. If you go back to work, you're not vaccinated, we're constantly getting tested everywhere you go, right? And so they're actually seeing a ramp up back in that demand. And we've heard about shortages of rapid testing kits in the US. Apparently in Europe, they're available everywhere. But Abbott will be reporting this week, so we'll get more clarity on that. But they actually brought their guidance back on decreased demand for rapid testing. So I'm not anticipating. I think it's gravy if that kind of continues for them. They're doing very well in their medical device division. Freestyle Libre is maybe your product you've heard advertised on TV. It's a glucose monitoring system for diabetic people. There's no pricking involved. So they're seeing good growth in some of the other divisions as well. And I think I feel like they spend money on R&D. It's just a well-run healthcare company, diversified, trading at about 24 times forward earnings. So it's not, it's more expensive than, let's say, you're a Pfizer or a J&J. But I think Abbott actually has less patent risk because they don't have this huge branded pharmaceutical division where you always kind of have to be watching, when your patents expire and managing that revenue growth profile when your patents come off. So
that makes sense. Yeah. Okay. Interesting. And then just lastly, you talked about your getting energy exposure through pipelines. I don't know if there's one in Canada you want to mention. You do talk about Algonquin. Yeah. Maybe more interesting.
So within the pipeline, within the pipeline space, we do own Pembina and Enbridge, and that's purely for the yield, because the yield is like over 6%. I mean, the stock prices have done well with the recovery in commodity prices. For Algonquin Power and Utilities, it's a regulated utility, about 2/3, and then a third is the renewables. And the renewable side, I think, is going to grow very nicely. The bulk of their revenues come from the state. It has a yield of about 4.5%. And one important aspect when we buy income stocks, because that's the category we put them in, we want a company that's going to grow their dividend annually. And they've done that. I think they have the visibility to continue doing that. And in the environment where we get to that environment where interest rates are rising dividends will be a buffer to rising interest rates, because always, as we know, it's a headwind for kind of utilities or income-oriented stocks. And so I think for Algonquin, they actually have the renewable space. They're growing, and they've actually announced a few contracts with Chevron and JP Morgan, where they will build the renewable power generation, whether it's through wind or solar. And these corporations will buy the power under long-term purchase agreements as part of their process to decrease their carbon footprint. So they're doing little partnerships with commercial corporations who are embarking on their renewable or green footprint strategy as well.
Okay. Lots of great ideas, Christine. Amazing conversation. Thank you so much. There's a lot of great content for people.
Thanks, Catherine.
Yeah, really appreciate it. Great to see you, and we'll speak soon.
Yeah.